John Haynes, Head of Research at Investec Wealth and Investments, is here. It's a big agreement, crisis averted for now, but it's kicking the can down the road for just 2 months, isn't it?
Yeah, but I think it's important that it appears that Congress has understood that actually they're playing with fire. It appeared that last year they didn't understand that, and the impact was quite negative for sentiment, which then teed us up for a very nasty mid-year as Europe failed to deliver on its political obligations as well. So I think it's a very important progress that whilst the US is beginning to show signs of life and actually some material improvement in the employment situation, that the defeat isn't snatched from the jaws of victory by the politicians. So it is a positive.
But there are deep divides still
Absolutely.
over how to cover this cost and over how to cut the deficit. That's the elephant in the room, isn't it?
The elephant in the room for actually Western civilization,
Yes.
as constructed, is that we have set up a social security system and support networks that we can't afford over the long term, and we have decided we have to deal with them now rather than in 5 years' time. The financial crisis has made it a pressing imperative to do so. That is why we are in such a fractured state, both in the US and in Europe, and ultimately we'll come to an agreement that society can live with. But the process of coming to an agreement is not a pleasant one.
In the US, that process might now not happen until after the election.
Absolutely.
That's
Absolutely.
what Fitch basically said. We'll cut to you if you don't sort it out after the election. We've got some breathing.
Yeah, what's happened here is Congress has recognised that actually an electoral process is how you sort these problems out, not an argument before the electoral process.
Are you confident then, long term, that the fiscal deficit in the US is solvable? And we'll come to the European crisis later.
I think America has a set of problems which are in its own power to solve and relatively straightforward. It is a case of deciding what side society support mechanism you want and then going for it. And I think that can be sorted out in an election and an appropriate series of arguments. Europe is a much more intractable issue, and I think the process of sorting it out is more difficult to.
We'll talk about Europe a little later. John, PIMCO warning the US may not even grow next year, 0 to 1%. Bloomberg consensus is 2.1%. Are you closer to PIMCO or closer to the consensus? I'm
probably closer to the consensus. I think there's some positive momentum in the US economy which could develop even more favourably than the consensus expects, and I'm a bit more positive about the US housing situation than, if you like, the consensus is. And I think we forget the multiplier effect that a positive momentum in the housing market can quickly have, both on the financial services industry, where the collateral that they've lent against is no longer depreciating potentially, and the consumers themselves, who no longer feel that they've tied up a vast amount of capital into something that is not an asset for them, it's a liability. So I'm actually relatively positive that the US will manage to more than muddle its way through.
What does that mean from an investment point of view, John, for next year?
I think from an investment point of view, it's a good environment to own US assets, certainly from the relatively defensive perspective. I said there's some internal momentum in the US that I think is more likely, in my mind, to break on the positive side than the negative side. I think if you look at the other alternatives in a risk-taking perspective, then you're looking at Europe and the Far East, and in Europe, clearly we still haven't come to the end of what is quite a high-stakes poker game. And in the Far East, the momentum that you're seeing that is driven from China is also slowing, and we're at the point where actually the authorities are beginning to think about re-stimulating. So that's also quite a tricky nexus in the situation. So if you were looking to put risk to work but at the low end of the risk scale, you'll be attracted to US rather than to the alternative areas.
And if you look at the global indices, I mean, the US on equities has outperformed the Dow, one of the few indices globally to actually rise this year. Might history repeat itself next year? I
think it's possible, but I certainly think it's a kind of a year of two halves is what we're looking at. I think all the risk is very front-end loaded next year, and I happen to think that the Eurozone has made some important positive steps, and that we will see the results of those as the year progresses, so that people's, if you like, disinclination to edge too far out on the risk spectrum will reduce as the year progresses, and the more exciting parts of world growth will be looked for later in the year. So US early, probably more developed markets in the latter part of the year. Yeah. If you want to play both, just go and buy global blue chip companies which have a leg in both camps. And I think the arguments for that as a secular strategy, if you like, a nifty 50 of global growth companies, is really very strong indeed.
OK, John, stay there. John Haynes, he'll be back with us a little later, talking about Asia. China, it's the biggie next year, isn't it? Especially if Western markets slow. How are they going to engender a slowdown that's not too hard-hitting?
Well, they've already been tightening monetary policy for some time, so now we've first seen the first signs that maybe they're going to ease up a little bit on monetary policy. So I think this time round, I think they are aware that there is some fragility to the amount of credit they've pumped into the system over the last 2 or 3 years. And one has to remember that they're having a leadership transition at the end of the year. It is unlikely that they want that to happen in an environment where the population is feeling under too much pressure. So I think it's quite likely that we'll see more rather than less support from the central authorities in terms of liquidity provision, in the desire that they don't overly stress what I think is at the moment peculiarly sensitive financial.
What about property curbs? Because they've been sort of clamping down on property. I mean, this is a big area.
They've said they want property prices to come down by 20%, and they're on the way down. I think at some point they'll declare victory and say, okay, that's fine. I think they want speculators to realise that there is risk as well as reward in investing in Chinese property. And I think the message is getting through. It's not quite there yet, but I think it's getting through.
Is China still going to grow in the region of sort of 8–9% next year, or not?
I suspect the official figures will be there. Yes, I think if you monitor power consumption and things like that, I would not be surprised to see it be at the low end of the range. But you're not putting the genie back in the bottle here. This is a society that has changed the way it thinks about how it creates wealth. And it is surging towards that and can only be restrained for so long. So I'm a very bullish and optimistic about what China does for the world over an 18-month to 2-year view.
And just very quickly, John, is there a way of us best taking advantage of that as investors?
Yeah, I think one has to expect that the wealth that's created by the Chinese diaspora is what you go after. So it's Hong Kong, China, Singapore. The whole region creates wealth rather than specifically China or specifically Hong Kong or specifically Singapore. So if you can buy funds that are prepared to invest in the whole region, I think you have a much safer and sunnier ride than by trying to cherry pick China itself.
Fascinating to see all these technology stocks and the promise of wealth and that one can make if you invest in them. But we know from the tech bubble and bust, don't we, John, from the late 90s, that there's a lot of risky investments out there when it comes to technology.
I think that's right, and I think what you're looking for is recurring revenue, and you're looking for genuine technology enablers, and you're looking for a service component that you can rely on. And I think from our perspective, if we're looking for technology investments for our clients, we're trying to make sure that they have a intellectual property content that is unbreakdownable by, if you like, the technology that has enabled the world to become more competitive. So the internet enables people to compete with all sorts of areas that they couldn't before. So for us, we think some things like semiconductor capital equipment, it looks very, very cheap and beaten up, and we know that the cycle hasn't been great. But in the end, you need it to do what society needs to build. And we think education is another area that you need to invest in. That LeapPad was interesting to us, but there are other ways of investing in education where you're creating the intellectual property and you're using technology to do that. And we think those are themes and money-making opportunities that you can exploit through the equity market and put into your portfolio for not just a year, it's a 3, 5, 6, 10-year cycle.
What sort of state is the Eurozone going to be looking like 12 months from now? The end of 2012. Let's have your crystal ball predictions.
I think it'll look better. Clearly, whether or not that's the likely outcome will be decided in the first quarter. We are at a stress point in terms of writing the rules that enable it to happen, the reshuffling of debt between actually who should own whose debt and how much of it. And I think we will find out whether or not the constriction of the room to manoeuvre that's being put upon the fiscally less sensible governments is actually effective, and they put in place sensible policies going forward which will enable the ECB to perform its function via the back door, albeit, but essentially being the lender of last resort. All those things happen, and we'll find out in the first quarter whether they are actually falling into place. And I think businessmen in Europe will start to feel better about life, and the banks, more importantly, will realise that they've escaped the worst possible outcome. The sword of Damocles will be lowered, if not sheathed, it'll be lowered. And the liquidity climate and corporate mentality will improve.
I like that story. I like that optimistic story you're telling there. But because I think there was something quite interesting that happened overnight or late yesterday, and this is the sale of the stake in Portugal's EDP to China. 3 damn gorgeous, 54% or 53% above the last traded market value. What does that tell you about the undervaluation of European equities?
What it tells you, which is, I think, obvious if you would speak to people in the boardrooms, is that there's a lot of pent-up risk-taking appetite. And you cannot, as a CEO of Europe or anywhere else, go out and buy any of these undervalued assets if you have no idea what the trading value of this asset is going to be in 3 months. You might be convinced over 5 years, but 3 months, you have a real problem doing it. So I think it's the sovereign wealth funds will come into the market and do something about the undervaluation. Real corporations will come in and mop up assets and rebuild the conglomerates, because that's a great space to be if you're in an uncertain world. But it's just being all pent up and bottled up by what is literally the Euro bloc. If we can look around that, great.
So what is so if there are some misvaluations in sectors like utilities, what about the banking sector?
The banking sector is clearly a 5-year absolute huge winner. It's just whether or not it's a winner from half the current price, or whether it's a winner from now and you make a lot of money. Now, it has always been the case that if you buy a financial institution that is a survivor and a reputable institution at around book value, you are getting an extremely good piece of paper. Well, you can do that a lot in Europe at the moment. The problem is you don't know whether the book value is what it says on the tin. So nobody wants to do that, and you don't know whether they're going to be allowed to be in business in the current form going forward. So our strategy on that is to say, okay, what we do know is that the top 10 financial institutions in the world are going to be around. Either they're going to be richer because the world's better, or they're going to be richer because they'll get everybody else's business for free. You know that for certain. So, or we don't have capitalism, which is a problem that it's too big for me to contemplate. So
put your money into the top 10 financial institutions in the world. So go and buy the top 10 financial institutions in the world and go away for 5 years. Now, it might go down over 3 months or 6 months, but if you have a 5-year investment time horizon, I find it inconceivable that that is not a good investment strategy. Is the Eurozone going to be in its current form, John, in a year, meaning will Greece still be within it or not?
It might not be Greece that goes out, you know. I was speaking to John Major from HSBC, who said it actually could be one of the stronger nations, not Germany, but something else. He didn't say, but it could be, you know, somewhere else. What do you think about that?
What are your forecasts?
I think if it breaks up by the strong guys leaving rather than Greece being pushed out. You know, in my mind, I think Greece stays part of the euro.
One more question, John, before I know David wants to show you his book. It's a question we're asking many of our guests. Are big banks a cure or a curse for the global economy, do you think?
I think they have to be a force for good. What they do is a social good, not investment banks. Investment banks are what investment banks have always been, which is they run around and they break up and they enact that force of creative destruction. So are they good or they're bad? I don't know. But what you do know is the old-fashioned savings institutions that gather your and my savings, put them together into large lumps, and then give them to corporations who take sensible risk and create value. They're a force for good.
Now, John, just before you go, David wants to promote some happiness.
Guess what? The European Union President Herman Van Rompuy is sending 200 world leaders all around the world. It's the World Book of Happiness.
Have you read it?
It's a very nice idea. I've dipped into it.
You have been smiling a lot today.
It's 100 essays from actually philosophers from all around the world. He's gathered them all together, or they've been together by a Belgian author, and Herman Van Rompuy has decided to send these around to leaders so they'll find them in their Christmas stockings on Christmas morning.
Lucky leaders. John, thanks a lot, and David, thanks a lot as well. John Haynes, the head of research at Investec Wealth and Investments.